Procter & Gamble out with its second quarter. The hodlers are going to keep it. Just moments ago, earnings of $1.84 a share is well above estimates of $1.70. Revenue of $21.44 billion was basically in line with estimates. The company also affirming full-year sales guidance. Join us to break down the numbers, which are always a lot to talk about, but sometimes it's the same things we look at. Jon Moeller, Procter & Gamble Chairman and CEO. John, it's good to see you. We always talk organic sales growth. You give us guidance. In recent quarters, you seem to be exceeding it. It was 4% this time. I think, what was it, 3 to 5? Where were you as far as forecast?
Our fiscal year guidance for the top line is 4 to 5. We don't provide a quarterly estimate. But this quarter, as you said, was very strong overall, starting with the bottom line, core earnings per share up 16% for the second quarter in a row, while, and this is important, increasing investments in marketing and commercialization of innovation by about 15%, together driving the 22nd consecutive quarter of 4% or better organic sales growth. One of the questions has been what will happen to volumes as we come out of this pricing cycle. Good news there as well. If we look at the U.S., past 5 quarters, -3, flat, +2, +3, now +4. Europe, +3. Aggregate market shares up about 40 basis points. If we look at the U.S., value share up 20 basis points, volume share up 50 basis points. So on a first half basis, that's about 5.5% top line growth, 16% core earnings per share growth, which, as you said, enables us to maintain our organic sales growth guidance for the year and increase our core earnings per share guidance from a range of 6 to 9 to a range of 8 to 9.
With some of the yearly guidance, John, you're doing some Gillette accounting changes about intangible assets, so it's kind of muddled. But did you raise guidance for the year for the bottom line? And if you beat it by 14 cents in the current quarter, did you raise it by more than 14 cents for the year, or just raise it by 14 cents for the year?
We raised it by a little less than that. We have a number of headwinds in the second half from a cost standpoint, and the pricing that we've been taking annualizes right about now. So there's less benefit from that. But still, overall, very healthy core earnings per share growth. We'll continue to be a strong dividend payer, and we'll announce our plans for that in April. But really, everything's in pretty good shape. If you look at the breadth of the growth on the top line, 8 out of 10 categories held or grew sales in the quarter we just completed. 21 of our top 25 brands held or grew sales. If you look at the top 12 brands, 9 of them were high single-digit plus growth rates. So things are going very well from a consumer standpoint. As I mentioned, volumes strengthening. There are, of course, challenges in the world that we live in, but the team has done a great job executing our integrated growth strategy to overcome those challenges, and I expect the same will continue.
There's a little bit of talk about China, beauty products in China. Is it tough operating over there?
I just spent a week in China 2 weeks ago. I spent time with consumers in their homes. I spent time in stores. I spent time with our retail partner CEOs and, of course, with our team, also with a number of government officials. And my view on the attractiveness of the long-term story there remains intact. Short term, it's rough. The confidence of consumers has not fully recovered since the reopening from COVID. Markets in our categories are down modestly year to year. But again, we're doing well from a share standpoint, and the rest of the business is more than overcoming that and several of the other global challenges.
John, I thought your margins were good, your gross margins, and you got it from a couple of, tell us exactly how much it went up, and it was productivity was the lion's share of it, but also price increases. But at the same time, you're able to increase prices. Commodity prices were actually moderating. So you're still able to raise prices, you're not passing along commodity increases. You're just able to raise prices even though your input costs are lower.
So first, the margin, gross margin up about 550 basis points. Operating margin up about 400 basis points. Very strong progress. The pricing that you're seeing there is really a carryover from pricing that was taken previously that has not yet annualized. And then there's a modest amount of pricing that's occurring in some of the emerging markets as we need to overcome the impact of currency devaluation. But in general, what you're seeing there from a price standpoint is pricing that was taken previously, and that's why it's so important to keep our eyes on what's happening to volume, which is going to have to be a bigger component of the top line going forward. And as I said, we're very encouraged by what we see there, particularly in our largest market, the U.S. Again, past 5 quarters, -3, flat, +2, +3, now +4.
In the consumer in the United States, how you would characterize, actually we're supposed to say she, I think, some people do, consumer, but the consumer in the United States, what happened?
Generally strong, very interested in our categories, in performance that helps address the problems they're trying to address. We've spent a lot of effort on innovation to ensure that our margin of performance is indeed superior, and the consumer's been very responsive to those moves. As I mentioned earlier, in the U.S., we're building market share, both value and volume, and that's pretty much true across the range of categories that we compete in.